The bond market is only half the story. The other half lives in bricks and deeds, the moment a district becomes a tenant. It starts with a cash crunch and a promise. Unlock equity in buildings without raising taxes. The pitch sounds simple. Sell a facility today, lease it back tomorrow, keep teaching in the same walls. Cash up front, no new debt on paper. But the minute the deed leaves, the school gains a landlord. Here's how it unfolds in a cabinet meeting. The facilities director lists roofs at end of life, HVAC failures, safety upgrades. The CFO shows dwindling reserves and a ballot that just failed. An advisor slides over another option, a sale-leaseback on non-classroom property. Maybe the admin building, a bus depot, a warehouse. You'll monetize an underused asset, they say. Then redirect proceeds into classrooms. The catch comes in the lease. 20 to 30 years, triple net, with annual escalators and limited renewal options. Maintenance, insurance, taxes, if any, shift to the tenant. That tenant is the district. Triple net sounds efficient until the first big repair hits. Under a standard lease, the landlord shares responsibility. Under triple net, the district pays for the roof on a building it no longer owns, plus rent that ticks up every year, often tied to CPI or set at fixed steps. Flexibility becomes a ratchet. Some deals even restrict reconfiguration or consolidation. If enrollment falls and the district wants to shrink, the lease still demands occupancy and payment through year 25. Meanwhile, charter operators and their backers learn to scale this model. Facilities funds buy or build schools and lease them to charter networks at cap rates that look attractive to investors. The returns start to resemble REIT plays. Long-term, predictable cash flows secured by public-to-pupil funding, often securitized through conduit issuers. When you hear facilities partner, think landlord with a calculator. If a charter misses enrollment targets, the pressure to cut staff or programs to meet rent intensifies. In some cases, lenders set enrollment covenants. Expansion, relocation, even closure dates can be negotiated in conference rooms far from the classroom. Now bring it back to a traditional district. A sale-leaseback delivers millions up front. Those dollars land like a lifeline, new boilers, ADA compliance, security upgrades. But they don't erase the new fixed cost. Every July 1st, rent is due. If state aid slips or local revenue dips, the landlord still expects the check. When budgets tighten, the district can renegotiate salaries. It can't renegotiate inflation that's baked into a lease escalator. A microstory. A Midwestern district sold its central office to an investor and signed a 25-year lease with 3% annual increases. Year 1, the proceeds funded classroom tech and a roof replacement, wins that photographed well. Year 8, utility costs spiked, enrollment softened, and the rent had climbed nearly 27% from the starting point. The district considered consolidating admin into an empty wing at a high school to save money. The lease blocked subletting and charged a steep fee for early termination. The board swallowed the cost. Art supplies were trimmed again. Another twist, control. Ownership lets a district rethink a campus. At a pre-K wing, carve space for mental health services, swap a library layout. Under a lease, any change can trigger landlord approvals, extra inspections, or rent adjustments. In some sale-leasebacks, the investor reserves the right of first refusal on nearby parcels, steering future planning. Over time, real estate strategy shifts from educational vision to negotiating leverage. The facilities map answers to yield. Supporters argue sale-leasebacks transfer risk and unlock capital without voter fatigue. Sometimes, they've helped build or modernize space that bonds and budgets couldn't touch. The problem is the discipline it demands. If proceeds patch recurring deficits instead of one-time needs, the district trades a balance sheet problem for a structural one, permanent rent replacing temporary relief. And with triple net, the risk doesn't really leave, it just returns under a different line item. Charter facilities deals show the other edge. Investors package properties, securitize rents, and market predictable streams. The financial engineering can be elegant. But when a school underperforms, the investor's remedy is real estate. Raise rent, enforce covenants, or move to evict. The community's remedy is messier. Find seats elsewhere, extend bus routes, close libraries to make room. The spreadsheet credits rent received. The map gains a school desert. During crises, these structures harden. In a downer, refinancing a lease isn't like refunding a bond. Landlords guard cash flows, They aren't obligated to help you through a bad year. If an escalator ties to CPI and inflation spike locks in higher rent at exactly the wrong time, the only flexible items left are people and programs. That's how you end up with a sparkling vestibule funded by yesterday's deal and a bare supply closet because this year's rent went up. There are better versions, shorter terms, modest escalators, repurchase options, true maintenance sharing, limited covenants. They require leverage and transparency that districts don't always have. And they demand a clear rule: never sell mission-critical classrooms. Own the spaces where students learn. If something must be monetized, start with peripheral assets, embed buyback rights, and disclose the lifetime rent in plain numbers before the vote. Otherwise, the classroom gets a landlord, and the landlord gets first say. The swap that backfired: derivatives in school finance. The pitch landed when rates only seemed to fall. Hedge your risk, advisors said. Swap variable rate exposure for fixed. Smooth the bumps. On a slide, an interest rate swap looked tidy. The district issues variable rate bonds tied to an index. A bank pays that index while the district pays a fixed rate. In theory, cash flows net to stability. In practice, the contract moved faster than districts could. Stakes first. Districts operate on thin margins. A 1-point jump in rates can drain hundreds of thousands from a budget that buys counselors and keeps lights on. The promise of a hedge was irresistible. Certainty in an uncertain time. Board saw a tool to lock costs, avoid tax bumps, and keep promises made to voters. Nobody wanted to explain volatility at a town hall. A swap seemed like insurance without calling it insurance. Here's what happened in too many places. Rates fell. Variable rate bonds got cheaper, but the swap forced districts to keep paying a higher fixed rate to the bank. The hedge became a drag. Contracts had teeth. Termination fees ballooned when rates moved against the district. One Pennsylvania district extended a swap tied to a project that never materialized. Unwinding cost millions. Another district's note and swap structure cost far more than a plain fixed-rate bond due to fees embedded in opaque terms. Meanwhile, something else was happening behind the scenes. Advisors who were supposed to be independent were often paid only if deals closed, or paid based on deal size. Underwriters got compensated when the structure grew complex. Fees hid in spreads and rate adjustments rather than clean invoices. District officials didn't always see the true price because it wasn't a line item, it was inside the math. Banks tweaked the fixed rate a few basis points, the upfront looked generous, and years later the district discovered those basis points were the real fee. The impact showed up fast when the economy cracked. Collateral calls, clauses that required the district to post cash if the swap's market value slipped, threatened reserves. Termination quotes arrived like bad weather. 8 figures to walk away, mid-7 to renegotiate. Refinancing lower-rate debt should have been a win. The swap stood in the doorway demanding a toll. Board meetings became triage sessions. What can we cut to pay this exit? Professional development. After-school programs. Staff. Regulators and auditors stepped in after the worst of it. Lawsuits flew over mispricing, pay-to-play, and undisclosed conflicts. Some reforms stuck: clearer municipal advisor rules, fiduciary standards, and disclosures under MSRB Rule G17 that force underwriters to put their role and conflicts in writing. But even with better rules, the old sales logic still surfaces when budgets are tight. Trade a little complexity today for the promise of stability tomorrow. The lesson is simple to state and hard to live. If you don't understand every scenario where the cash flows turn against you, you don't own a hedge, you own a bet. A microstory from a superintendent's notebook. The call came at 6:40 a.m. We can't issue today. The swap value swung overnight. Termination cost just jumped. By 8 o'clock, the district's refunding that would have saved $2 million over 10 years was off. The maintenance director pulled the summer roof schedule. 2 buildings moved to next year. Teachers felt it as buckets in the hallway after the first autumn storm. Advisors will argue that swaps can work when paired with real variable rate exposure and strong liquidity. That's true on paper. Large, sophisticated issuers with treasury staff and daily market access can manage basis risk, counterparty risk, and collateral. Most school districts are not that. They have one CFO, a part-time board, and kids who need buses to run. A swap's worst day demands cash you can't print and expertise you can't hire mid-crisis. Pennsylvania case files and audits after 2008 made that painfully clear. The quiet cost is psychological. Once a district carries a derivative, finance starts to dominate strategy. Decisions get made to protect a mark-to-market number rather than to serve students. Leaders schedule rating calls before curriculum meetings. The swap is a presence in the room, even when nobody says its name. There's a rule that protects classrooms. If a structure can hand you a bill bigger than your book budget with a single rate move, it doesn't belong near children's schools. Call it conservative. Call it boring. Boring keeps orchestras. Boring finishes gym floors. The advisor problem: conflicts, kickbacks, and independent guidance. Walk into a bond kickoff, and the seating chart tells the story. At one end, the superintendent and a couple of board members. Across from them, underwriters, municipal advisors, bond counsel, disclosure counsel, paying agent, trustee. Everyone smiles. Everyone says they work for the district. Only one party may owe a fiduciary duty, and that depends on who's engaged, how, and when. Here's why it matters. When a district chooses a municipal advisor with a true fiduciary duty, engaged directly, paid on a flat fee not tied to deal size, that advisor is supposed to say no when a structure hurts students down the line. But a lot of relationships weren't built that way. For years, advisors got paid only if a bond sold, or a refinance closed, or a swap inked. Compensation rose with par amount. Bigger deals, more fees. That tilts the table before the first spreadsheet opens. Stakes come into focus in a small scene. A board workshops options for a bond. The advisor presents 3 scenarios and recommends the largest, citing market windows and investor appetite. Nobody at the table hears the advisor's compensation changes with the par amount. It isn't on a visible invoice. It's in a percentage embedded in the closing documents. The underwriter, meanwhile, is obligated by rule to disclose its role and conflicts, but those letters land after momentum has built. By then, the renderings are already in the slide deck. Action looks like this. An RFP goes out, but it's written by a consultant who knows exactly which firms can check the boxes. Prior work, required. Minimum deal count, high. Approach to swaps, innovative. The same names show up on the shortlist. During interviews, everyone promises independence and best execution. After award, the advisor helps structure a deal that threads political needles. No rate increase, long final maturity, deferred principal. The fee, tucked into costs of issuance or paid out of a spread. Placement agents appear if the deal is private, remarketing agents if it's variable. A trustee is named. Each takes a slice. None of those slices show up on a teacher's pay stub. They live in basis points and closing statements. What nobody outside that room sees is the quiet pressure to please rating agencies. Advisors coach districts to build fund balance reserves and adopt policies that look good in a credit report. Sensible up to a point. But when the primary client becomes a rater's model, the classroom becomes secondary. Districts pledge to keep 15% reserves while laying off aides. That's not an accident. It's a strategy to defend a rating that lowers borrowing costs. The advisor can claim savings. The board can claim prudence. Kids lose support. There's a darker corner. Pay-to-play scandals, contingent fees, and steering have turned up in audits and lawsuits. Opaque compensation leads to subtle steering, toward structures with more layers, more roles, more recurring fees. A simple fixed-rate competitive sale becomes a negotiated sale with optional insurance, a forward delivery, or a callable feature that's illusory. The pitch emphasizes flexibility and market access. The closing statement tells the truth in numbers no one reads at the podium. A microstory. A district went to market with a negotiated sale. The advisor argued a competitive bid might leave money on the table, given complexity. The underwriter proposed adding a premium coupon to broaden distribution. The result, higher stated coupons offset by bigger premiums at purchase, satisfying investors' preferences but complicating the district's yield. The all-in cost looked fine on the day. Over time, call constraints blocked a refinance that would have saved millions. The advisor's fee, a percentage of par, paid, regardless of later handcuffs. To be fair, reforms pushed after the last crisis forced clarity. True municipal advisors must register and carry fiduciary duties. Underwriters must deliver conflict letters at or before engagement, and they can't pretend to be advisors. Best practices from finance officers groups urge competitive selection, proof of insurance, and disclosure of any fee splitting. Good advisors follow this. They publish their fee schedules, reject contingent comp, and recommend plain vanilla when it's cheaper. They've saved districts real money. But procurement theater persists. RFPs ask for glossy binders over hard commitments. Boards rotate. Institutional memory fades. The same firms return with new faces. The fee machine hums because it's quiet, spread across roles few voters understand. Placement agents line up buyers for private deals and earn a cut. Remarketing agents reset rates and earn ongoing fees. Trustees charge annually to hold funds and send notices. None of this is illegal. All of it is incentive. Impact lands in choices you can feel. A district that overpays half a point in spread on a $100 million issue sends about $500,000 a year to investors and intermediaries instead of into classrooms. A swap termination fee rearranges an entire staffing plan. A remarketing fee persists for decades, an electric bill you never see but always pay. The worst part is subtle. Leaders start asking, what will the market think? Before they ask, what will students need? There's a way through. Demand advisors with true fiduciary duty and flat fees. Require full written disclosures at engagement, not closing. Publish lifetime cost ranges on every ballot. Prohibit contingent compensation. Rotate underwriting pools. Insist on competitive sales unless a concrete, documented reason says otherwise. When in doubt, choose boring. Boring doesn't call you at 6:40 a.m. with a price you can't afford. Boring lets the orchestra rehearse. Crisis test, COVID, inflation, and the great budget squeeze. The stress test arrived without warning. 1 week, districts were debating a modest refinance. The next, they were closing buildings, handing out laptops in parking lots, and stapling hotspots to bus routes. Revenues slid. Cafeteria sales disappeared. Attendance-based funding formulas wobbled. The operating side bled while the capital side stayed rigid, because debt service doesn't take snow days or pandemics. Stakes were immediate. Payroll had to clear. Custodians needed PP. Ventilation that had been good enough needed MERV, 13 filters, and engineering studies. Then came the paradox. Washington sent emergency aid, and for a moment it felt like breathing room. ESSER dollars landed, meant for learning loss, air quality, nurses, tutors. Districts booked the grants and kept people employed. On paper, fund balances looked healthy. Underneath, a clock started ticking. Meanwhile, the market had its own panic. Funds sold what they could, not what they wanted. Dealers widened bid-ask spreads. Planned refundings slipped as volatility made savings vanish. Districts that had lined up a spring refunding to shave costs watched yields jump in days. The call date on older debt didn't move, but the window to capture savings slammed shut. A superintendent called it, trying to change a tire while driving on black ice. The bond calendar wasn't the only schedule that mattered. Leases with CPI escalators quietly ratcheted higher as inflation spread through the economy. Triple net obligations on admin buildings and bus depots got more expensive exactly as utility bills spiked. No landlord paused increases because a third-grade cohort needed math intervention. The rent was due on the 1st, regardless of case counts. Back in classrooms, the aid paid for tutors, summer school, mental health support, ventilation. It also hid the structural gap. ESSER dollars weren't permanent, but salaries are. Some districts used grants to avoid layoffs and stabilize staff through the chaos, which made sense in the storm. Others plugged recurring holes without a plan for the cliff. Everyone knew the acronym, ESSER, and everyone knew it would end. The question was when, and what would be left. Investors watched the same horizon. Official statements started to include pages on pandemic impacts and federal relief. Ratings analysts asked pointed questions about how districts would unwind one-time spending and rebuild reserves. A district that used grant funds to backfill operations got flagged for future stress. A district that saved most of the aid for capital-like ventilation projects earned a nod. The incentives were clear. Protect the rating, even if that meant slow-walking services families were begging for. When buildings reopened, inflation was waiting at the door. Diesel cost more. Food cost more. Bids for roof work came back 20% higher than pre-pandemic estimates. A gym floor that would have fit last year's budget now required a change order and a board vote. Teachers needed raises to keep up with prices, and they were right to ask. Debt service didn't budge. Lease escalators didn't blink. The movable parts were people and programs.